In this series, we're going to talk about covered calls, one of the most popular option investment strategies. Our goal here is to help you understand what a covered call is, what risks and rewards they offer, and common techniques for managing them. We don't promote any specific approach to options investing and aren't advising you to follow any particular program. However, we will assume you have a basic understanding of what options are and how they're traded. So let's talk about exactly what a covered call is. As the name implies, this strategy involves selling a call option for a given stock. While selling calls can be a risky proposition, your liability here is well defined because you simultaneously hold the shares you would be obligated to produce if the option were exercised. In other words, those shares completely cover your call obligation. Sometimes you'll see the term buy right used, which means that you're just buying the stock at the same time you're selling the call. Either way, the end result is a covered call. So let's take a look at the payoff diagrams to see exactly how a covered call is expected to perform. First, here's the P&L for a stock position. By definition, you would gain $1 in value for every dollar the stock price rises. Similar to that, here's what a long call position looks like at expiration. As you can see, the maximum loss occurs at or below the strike price, and you would gain $1 in value for every dollar the underlying rises. However, you're not buying this call, you're selling it, so the return is inverted. If we combine the long stock and short call positions, we can produce an expected profit diagram for the covered call position. A covered call has capped upside since every dollar gained by the stock above the strike price is lost to the short call position. On the other side, the loss potential is substantial since the stock could theoretically drop to zero. Here's a look at a covered call position in yellow relative to the long stock position in blue. While the covered call position does sacrifice some upside, it provides the benefit of an increased likelihood of profit. We cover the risks and rewards of covered calls in more depth in another video. So let's think about why someone would want to use the covered call strategy. One reason this strategy is commonly used is to acquire a stock at a lower cost basis, since the call premium partially offsets the price of the stock. The holder can then keep rolling calls against the stock to continually earn back the money invested in the shares. Another reason for selling calls could be if you hold shares that have had a significant gain and those gains are unrealized, and cashing in would produce a large tax bill. Selling calls could provide an opportunity to milk those holdings for income without having to sell the stock itself. At other times, you might sell calls in an effort to hedge holdings you expect to stay flat or even drop. Or, like any other premium sale, you might just be looking to capitalize on calls that you think are too rich relative to the expected movement of the underlying. In addition to understanding why you might want to enter this kind of trade, we always recommend thinking about why someone else would take the other side of your trade. While there will always be market makers willing to take the other side of any trade for a price, you'll get better pricing with an increased chance for success if you're trading something other investors will want to be on the other side of. In general, optionable stocks have pretty liquid shares, so you don't necessarily need to worry too much about who's willing to buy or sell your shares. As a result, the main thing you're thinking about here is who will want to buy your call. The first counterparty motivation could be as simple as someone wanting to express a bullish view with a long call. Another motivation could be someone opening a short stock position that they're hedging with a long call, which is known as a protective call position. It's bearish. Long calls are also regularly needed by investors managing complex books in order to meet their book goals, such as delta neutrality. And finally, someone will always step up to take your trade when they feel the reward outweighs the risk. Of course, this last scenario generally isn't what you hope for, since it means you'll be giving up a lot just to fill the order. So that's the basics of a covered call. It's a defined risk trade that offers a capped upside. In the next video, we'll go into more depth regarding some of the important risk and reward considerations for this strategy. And if you have any questions, please leave a comment below or reach out to us at hello@quantra.com. As always, Good luck and good hunting.